A very good morning, ladies and gentlemen. Well, I would urge all our members of the audience outside to join us at track 3 as we're about to begin on our next session that will deliberate on Bharat Lending Blueprint 2030, shaping the future to democratize credit. So I would urge all our members of the audience outside to please join us at track 3. That's where we begin with our next session. And just a quick note for all of you that track 3 sessions here will be focusing on lending. So all our members outside who are really looking forward to conversations on lending, I would urge you all to please join us in this hall. We have our next speaker right here. He's about to begin with a session on shaping the future to democratize credit. So I would urge everyone to join us at track 3. People sitting behind, I would urge you all to please join us at the front seats. If you all want to really experience all those conversations up close and personal, I would urge you all to please join us at the front seats. In the next 1 minute, we are good to begin. So I would urge everyone to please join us right here.
Yeah, thank you everyone and good morning and welcome you again to Bharat FinTech Summit organized by the Digital Fifth. So this session primarily we're going to talk about that how the lending is going to shape up in the next 5 or 6 years, right? So that's where that fundamentally is that we are going to focus that how it can democratize credit. What do you mean by democratize credit, right? So we'll touch upon that. So we'll touch upon that, how the vision looks like 2030. This is based on that our research we are consulting from. After talking to the various industry leaders and doing our research that we have put on some of this vision that we'll talk about it and how the future of lending looks like. And then how do we fill up the gap for the Bharat, right? Where the challenges of the lending lies into that. And that's where we are talking about democratization part of it. So largely, if you look at the lending today, is being focused toward the salaried, right? So there where the loss of the things has been simplified, but still the lending is not available to large population, be it on the gig workers, be it on the individuals who doesn't have the rights or the, measurable income part of it. That's where the challenge lies. So how do you want to make sure that credit is available to the larger population of the country, right? And that's where that we are talking about the democratization part of the lending. Just a snapshot of the country, if you try to look at it, we are right now into the era where that we are transforming in a bigger way, especially on the digital front, be it on the government digital public infrastructures, from the authentications to the payments and all these things, right? We are almost like a 1.44 billion populations. And if you look at it in the country, the internet penetration, the mobile penetration is continuing to increase, right? And that's where that whole the solution lies in the future. Look at some of the statistics, almost 22% financial app download, like 22% population have an access to the financial app, but they may not have that access to the loan part of it. Okay, that's good thing or not good thing, I'm not sure, but 17 hours of the weekly time that we spend on the smartphone. And let's look at that. What we're talking about, the time spent on the mobile is all about the data generations. So these data, as it gets generated, how the data can be used to make some kind of decisions on the lending part of it, right? Eleanor spent time on the banking, including transactions, right? So that's where that, I think 40% of population is expected to the urban center. When you talk about that 40% people being in the city, where that typically they will have access to the most of the digital infrastructure. They are part of the digital infrastructure. Look at the auto drivers on the road. They are taking phone pay or the Google Pay to collect the payments, right? It means that they have access to the digital data. 65% of the rural household still rely on the informal credit sources, like typically they need to go to the local munsi to get the money, right, for their purpose. So that's where the challenge lies. 50 million new to credit consumer will be added in this year based on the data from the Experian, right? So that's where that means that these 50 million, when they get added, 5 crore people may not have an access to the data because they don't have the bureau report, right? So because one of the critical element of the lending decision lies onto the bureau data, so they will not have. So how do you going to make sure that they still have an access to the data lending, right? This is just a breakup of, if you look at it, the lending distribution in the country, right? 42% on the retail side, which distributed among home loan, property, auto, personal, and two-wheelers, right? Only the personal loan, if you look at it, and the two-wheelers has lots of the digitization has happened, but large segment where that earlier masterclass I was talking about how things going to move on the secured lending side. Commercial loan, where that typically MSME lies into the center, almost 51% of the MSME gets a loan. And MSME, if you talk about that 65 million population in the country, of the MSMEs, only 10% have an access to the formal credit, right? It's a large chunk of the population still doesn't get that MSME loan. Corporate is typically, they have a different method. Microfinance is 3% only because these are small ticket loans, but still there are lots of the challenges of the microfinance because these are the individuals, women and men in the villages where that typically they come to the groups and they're able to get that access to the loan. What are the challenges that typically, if you look at it, I was talking about salaried is the best in class. Everybody who loves them, they want to give it a loan, be it on the banks, NBFCs. Fintech has come and they try to change, trying to go away from the salaried. Small and medium enterprises only with who have got the structured revenue, like they may have the ITR, they may have some level of the digital data available, and that's typically they're able to get the loans, but 90% of the MSME still doesn't get the loans, right? Government and public sector employees, again, it's a salaried class. So these are the segment where that almost lending has been sorted out. But these are challenges where MSME, they don't have any kind of the collaterals, right? They don't have property to mortgage, they don't have any kind of shop to mortgage. How do they get the loan? They may not have the structured income, so they will find a challenge to get a loan. And typically banks or NBFCs, if they want to give a loan to MSME, they'll rely on the security collateralization. And if they don't have the security collateralization, how are they going to get the loan? Employees in the unorganized sectors, again, so the guys who are working with the MSMEs, they also typically they don't get the loan, right? So that's where the challenge is. Women, gig workers, freelancers, these are again, they may not have the structured income that you can calculate. What is his average balance on which that you can calculate your EMI? When you're trying to calculate your EMI, you rely on that static income, right? Flow, that's where that you can decide that what kind of the money he can pay back. So these are the typical challenges where we see. What are the problems to solve? So if you want to give a loan and democratize the credit to the segment that we were talking about, MSME or people working in unorganized sectors, women typically, let's say even the people who are working professional and their wives, like my wife can get a loan, right? But they may be spending a lot on the Amazon or the Swiggies of the world, right? But they can't get the loans. So underserved segment, where that we need to, in the next 6 or 5 years, banks and NBFCs has to figure it out, how do they get an access to the credit, right? Challenge of the risk and credit assessment, because if they don't have the structured income, they don't have the identified source of the income, how do you going to figure it out that assess that credit ability to pay back, his ability to pay, you will have always a challenge. Collateral challenges, typically they may not have either the collateral, or even if they will have the collateral, it may be in a kacha pakka bills, where you can't establish that actually this property belongs to that individual. So how do you going to give the loan against that? You will continue to have regulatory and policies, because that's where that in fact government or regulator intent is that people should not get a credit where they may not be able to pay back, right? And that's where they try to control that whole of the things that unwanted credit should not be given, right? But they should be given in the right manner, and that's where lots of the government regulations are continuing to work in that space. Like the government is working on MSME, creating entity locker or Udyam certification and all these things, some kind of the identification for the MSMEs. That some work is going on. High cost of credit, because acquiring these customers which are not in the salaried, which are not in the corporates and all these things, they find it a difficult. So you need to reach out, you need to have a challenge of the KYC documentations, collateral documentations. These are the typical challenges which leads to the cost of the credit. And lack of the data aggregations, the account aggregator is there, but still the adoption is early stage where that you can aggregate all the data which he may be having, or the data from the other places, like say, for example, is whatever that he's transacting on the mobile, right? Can you get an access to that data, the telecom data, like what kind of the calls that he's making and all these things. So those are the data aggregation I'm talking about. You'll have challenges. And the same, if you're not able to reach out to that customers for the sales part of it, how you're going to do the collection. I give an example, like collections typically, can you figure it out that as a source of the credit itself that you were able to collect the money, right? Like say, for example, farmers who are there in the villages. I take an example, one of the startup that we were working. Now they were working with the farmers. Farmers used to come and pour the milk into the collection center, And farmer used to get the money from the dairy directly. Now, can you figure it out a mechanism that you're able to collect the EMI from the dairy itself rather than money going to the farmers and then you will to collect. So these are the collections typically challenges you will have there. You need to find out some kind of innovative ways to figure it out, the collections. So let's begin to that, what we are trying to look into the future. So just few aspects that we'll touch upon, where that how this has been built, right? Where when you are looking at the 6 years down the line, you need to work on access, you need to work on the affordability, that loan is affordable, you are able to inclusion, right? You can get a large segment of the population which is untouched to the credit, how to bring into the umbrella, and it's a sustainable in the structure, right? Just few pointers. Continue to build and expand the digital infrastructure so that credit can be made accessible to the large populations, right? Continue to build on the innovations on the credit products, like merchant cash advance came into as a product, lending product, where for some of the shopkeepers who is using the QR code or the POS machine based on the data, where that it can derive the income, you are able to figure it out. So these kind of the innovative credit products that need to come out. What kind of the product you can give the loans to gig workers, like delivery boys from the Amazon or the Swiggies, and continue to increase the credit penetration to the larger tier 3, tier 4 cities, as well as your rural areas. Affordability, you need to look at that cost of acquisition, cost of servicing to these customers is low so that the bank's able to, or NBFC able to extend the credit, because that's where they typically find a challenge. And that's why one of the reasons that you will find that cost of the credit to these guys are very high. Typically, MSME gets a loan up to what kind of the rate? Anybody from audience? Those who doesn't have the complete right side of the income or right side of the collaterals. 20% still is the good side of it, but it can hover to 35% and 40%. Like RBI regulators continue to try to keep a plug-in, but they still can go to the 35 to 40%, 50% also by through some of those lenders, right? So you need to bring out the cost of acquisition, servicing, collections, right? Then where you can manage the cost part of it. You need to figure it out how you build a cost-effective credit delivery model and personalize based on the data-driven. So that's where that you are going to build on the affordability. Inclusions, a special focus on, you need to work on the women, entrepreneurs, farmers, and gig workers. You need to understand the segments, then only you're able to deliver the loans to that kind of the guys, right? It's very critical to understand their personas, that how do they behave, how do they earn the money, how do they spend, and that's where that primary basis you will be able to give the loans, micro loans. So now the democratization, one of the element is that how do you kind of reduce the ticket size, because they may need just 10,000 rupees to buy some kind of an inventory for their shops, right? They may not need like 5 lakhs of the loan, but can you give the 10,000 rupees of the loan? And how do you be able to bring out that urban and rural credit part of it? And the last is sustainable. You need to have a very robust risk assessment method so that at least you continuously monitor, because these are uncharted territory that you are getting into for your loan, and you may have a challenge of the risk part of it, like you may experience unknown risk. So how do you build a sustainable infrastructure, be ethical and long-term financial stability through the system? Now let's look at that. This is again, I was reiterating based on the interaction with the industry leaders, as well as based on our exercise that we do with our partners, customers. We try to figure it out that you may, in the 2030, these are the areas where that you will see the impact. And it may not cover all the aspects, right? But still we try to cover some of the key elements across product, people, technology, and customer support. So let's look at some of the elements, what can happen on unsecured lending. And unsecured lending, when we are talking about, primarily we are touching upon that unsecured lending to MSMEs as well as to your gig workers and everywhere. You may get that 90% of loans in the less than 5 lakhs, typically in a day, because your digital infrastructure continue to evolve. That's what we're talking about, right? So you may start seeing the time impact, because that's where typically these guys get frustrated because they are not able to get loan once, and even if they're getting loans, it's delayed on the process. Look at from the shopkeeper's perspective. If he's not getting the 10,000 rupees to buy an inventory, he may have a challenge to sell, right? So that's where he needs the money so that he can buy. I think this is where the challenge lies into that, because if you look at the salaried, which is in a much loved customer segment where that you give the loan, you will find that they get the loan on the 10 to 15%, and these are average. If you try to look at that, MSME will have a variation, like they may get 8 to 40%. The gap, you will figure out almost 8 to 25% of the gap, right? So they get the loans much higher than the any salaried class. This is typically we expect to come down because of the loss of the use of the technology. It may come down to 6 to 12% by the 2030, right? And the same for the rural segments and all these things that we'll see, that the baselining, the rate gap between that salaried and to these segments will typically start seeing that impact. I think this is where that already work has started working, where the microfinance typically has been given to the joint liability group, where that 6 or 15 guys comes together and they get a loan because everybody takes the joint liability. But now the focus continue to how that you can give the loan to the individual, because each individual may have a different requirement for the loan, so that you can be able to work it out. This is very interesting. I'm going to love it, right? So I've been talking about that typically PD, personal discussion for the loan, and if you're trying to do, you need to visit to the customer, or people have started using that video PD, like somebody is logging in and interacting with the customer on the video calls. As the things continue to move on, we may see that the robot or the agent, AI agent interacting with the customer. They may be initiating the video call. Sorry. They may be initiating the video call, and they may be performing the entire personal discussions. And it may not wait till 2030, the way we are moving fast on the AI part of it, right? So this is one interesting, and this may be applied to the across your video KYC for secure lending, unsecured lending, that can be done. Let's touch upon some of the secure lending. In fact, in the morning masterclass, I was talking about that lots of the things happening in the secure lending space, and that's where we may start seeing a change. Today, if you look at only the 15 to 30% part of the entire secure lending process, between the KYC to the underwriting process to the technical, the legal valuation, is still very lower side of the digital. By 2030, as these are the platforms continue to mature, lots of the AI analytics continue to be used, we will start seeing that 60 to 70% of digital. Undoubtedly, may not see the 100% of the digitization because it's very difficult, but at least we will start seeing the 60 to 70% of digitization. Ultra-fast TAT, right? That's again, because you are using lots of the technologies like agentic AI for the PD, technical valuations, the legal valuations, and all these things that you are able to plug in. You may start seeing that the day from 25 to 30 days may start coming down to 3 days. That's where that we see the future lying into the secure lending. That will be dramatic improvement. This is again already started happening, but we may see lots of its adoption. Like when you are doing a property verification, especially the land verification, somebody is getting a loan for any plot. How can you use the technology where that individual doesn't need to travel 10 kilometers or 15 kilometers to do an inspection? Can you use the drone part of it that we can start doing the analytics, right? And that's where primarily it start capturing that whole of the localities, the markets, the connectivity to roads and everything. These are typically drives your valuation part of it. So how can you start getting that measured through that, not individual, but through primarily using technologies that will help you to do the valuations. This is interesting because technology as evolves, we may see that impact on the people also. And we are already started seeing, so typically if you look at the product manager who is conceptualizing the whole of the journey, designing that entire the flow, designing that entire the product construct, they may need to have, right now anyway, they need to have a good understanding of the APIs, right? How the data flow between the two systems or the two partners. But tomorrow you will expect that they also start understanding that how the AI is getting used. So they need to have an understanding of the API plus analytics to be a right product manager. That's where we will see that on the people side of the impact. I think credit policy, so as the analytics continue to get deeper into the whole of the lending process, credit policy or the credit team may have a lesser work that will give lots more their bandwidth to do a more application processing. But at the same time, they may need to be agile and to redesign the credit policy because analytics AI will keep on throwing the prompts that these are the changes that need to be done. So that's where the credit team has to also have a very much deeper understanding the AI. They need to have the agility into continue to redesign the policy. And this we are talking about the kind of the product that we need to have that in the market, be it on annuity, so that you can target the larger segment of the populations, right? Then again, this is again on the AI deeper uses of technology. So today, if you look at it, any lending application or any kind of the infrastructure, if it gets down, any services, somebody has to go do the analysis and then troubleshoot, or maybe worse, restart the services to start the process, right? If during the month end, if any impact happened to the lending application, I'm assuming that many of you may be coming from have that same experience, like 70 to 80% of the volume get processed during that time. I feel like half an hour or 1 hour of the downtime of the system also can have a large impact on the entire that output for the month. But you may see that lots of the analytics coming into the infrastructure level as well as the application level, you can self-heal. Moment certain issues has happened, it automatically try to reassess, recorrect, and let the system work. So we will see lots of the self-automations, self-healing kind of the application coming into the process. An application may continue to get intelligent to redesign the flow itself on its own, right? Because certain, each individuals may have a different journeys flow. I think evolution of LOS and LMS will happen. So that's there because as I was talking about that they may redesign their journeys as they see the different customer profile and all, so they may do that. This is again also very interesting. The business rule engine typically when it's heavily dependent on the analytics guys as well as the credit policy guys. And they will decide that, okay, what tweaking that need to be done on the business rule engine so that it can scatter to the analytics of that particular credit, right? Now you may have the self-learning AI capability built into the BRE where that it can go based on the certain requirement changes in the collection methods and all, it can self-redesign and can self-evolve, right? And the last piece on the customer support, you may see lots of the uses of the AI chatbot, multilingual, voice ports. These are the things typically will improve on the customer support part of it. And the nudging, like collection and all these things, typically rely largely on the individuals. But there also we may start seeing lots of the technology where customer can start getting nudges quickly. So I'll take a pause. Most of the things has been largely been covered because we have already have the next guest speaker already in the room. So I hand over to Priya. Please take over. Thank you. Thank you, guys. Thank you.